Local real estate, crashing or window of opportunity? Understanding today's housing market. What is your dream home? Is it modest? Perhaps it's large or really large. It all sounds good, doesn't it? But wait, hold that thought. We can't forget about the bubble. This is no time for dreams. The market is bad. People are losing their homes. Prices are plummeting. The party is over and the bubble has burst. I hear the market's all dried up, that lenders won't lend. Deny, you can't get a loan. I hear the hot market has new meaning, that it's a huge gamble, a big waste of cash. I prefer to follow the crowd, do what I'm told. And besides, I hear it's a disaster out there. After all, I think it's just rosy right where I am. Okay, you're right. We'll just listen to the news. It's got to be true if I read it in the paper or saw it on TV, right? Right? Well, let's take a look and see. How about New York Newsday? They posed the question, when will Long Island's bubble burst? 1986? Wait a minute. What happened there? Another try. This time more definitive. The bubble will burst. Whoops, wrong again. 1989. Okay, let's try somewhere else. Prices up 45% in 2 years. Guess it's too late to buy there. It certainly can't go higher after that. Then again, I guess it certainly did. So you can see the point here. When it comes to a transaction like purchasing a home, do not rely on the news. When you need your plumbing fixed, you call a plumber. When you need your own plumbing fixed, that's not the guy you're going to call. So let's not get our financial advice from a reporter. When it comes to these decisions, there are always many people in our ears. Uncle Mike, our know-it-all brother-in-law, our parents, or in-laws. But chances are, the last time any of these people actually bought a home may have been many years ago. We need to work with people that are professionals, doing this every day. For every situation is different, and every day, things will change. So let's get started with the facts. And as our source, we're going to reference the Home Economics Chart. Great question. The Home Economics Chart is a 44-year-long visual historical analysis of the real estate market and the many factors that truly support and drive it. Another good question. Healthy skepticism is a good thing. This chart was created using information from a whole host of different organizations, and they're all listed right here on the chart for you to see. Many of them are governmental agencies, and accordingly have no vested interest in twisting facts for their own gain. As well, spanning such a long time period, there is simply no way to distort reality without it going too far and becoming obvious. At the core of the chart are the national median price line and the national median trend line. You can see that we have not had any wild deviations from the trend, and that the progression of values across this country has been pretty steady. If the bubble theory, so common in today's media, were true, we would have seen the price line do something like this. When in reality, we have a price line that spent many years below the trend, and during this so-called bubble, only returned to, rather than exceeded this line. Now, we have actually gone below the trend. For the benefit of future slides that refer to leveraged returns, here is an example. If you purchased a $100,000 home, put 20% down, or $20,000, this would be your total investment. If the $100,000 home appreciates at 6%, you can see how your leverage yield would be 30% return on your total investment. Over the last 44 years, appreciation has averaged better than 6%, and the average rate of return on a 20% down payment has been better than 32%. What it can be called is cyclicality. All commodities markets, be they gold, grain, oil, or houses, are cyclical. It should come as no surprise that we had a boom. After a period like this, which was a long period of below average appreciation. Up, down indeed, sun up, sun down, tide in, tide out, low appreciation or even no appreciation this year. But can you guess what happens next? Is this beginning to register? We can see that the facts are quite different from what we've heard on the news. Let's get the facts on rates. Here we see fixed mortgage rates, the prime rate, unemployment, and inflation. The averages are clearly labeled. We see that the 44-year average for fixed mortgage rates is over 9%. So that just proves that where we are now, around 6%, is a really great thing. Let's highlight two time periods when the Fed lowered the federal funds rate. The prime rate will move in lockstep with these cuts. But we can see that mortgage rates might not. All we hear is doom and gloom. Dark, dreary, gray, fire, disaster, and of course, foreclosure. Let's look at the reality of that. We probably all know of a house or family that is suffering from this. Some areas are hit harder than others. Did you know the company that reports most of this has been found to be triple counting the statistics? They count each default, notice of sale, and bank repossession as though they were separate instances, even though it's all the same house. But they wouldn't tell you that on the news. Now would they? So yes, there are some areas that are bad off, primarily where there was a lot of speculation and fraudulent loan applications. This shouldn't really be a surprise. Of course, some are due to the same reasons that have always caused them, like divorce, illness, disability, job loss, etc. Reality is, there are over 110 million homes in this country, and 1 or 2% of those may ultimately be lost to foreclosure. So a million or two that will, and 108 million that won't. Values are going down, in some places anyway. Did you ever hear your financial advisor say, buy low and sell high? Ask yourself, if I buy today, how long would I stay? On average, it's 7 to 10 years. Where do you think values will be in 7 to 10 years? This is what history tells us. No, it won't be a straight line. It will have some squiggles, but that's okay. Those are normal cycles we've always seen. So buy low and hold. Yet another example, this time from a big stock brokerage firm. Again, we have twisted numbers from an unrealistic perspective. This shows a $100,000 investment in stocks versus real estate. Problem is, they're forgetting some very important things. Very few people pay cash for houses. They borrow the money. And that's okay because it creates leverage, and leverage will multiply your rate of return. Here we see the more realistic version, and that's where a $100,000 investment in real estate typically means you're buying a $500,000 house with a 20% down payment. Since we're being realistic, let's draw in what stocks usually do compared with a much more stable real estate. Now, after 30 years of owning real estate, do you know how much more valuable the difference would be? Well, here's a hint, and here's the answer.